Most investors think their biggest enemy is the market. That belief alone is what quietly drains their accounts. To make a long story short, markets don't destroy portfolios. Uncontrolled losses do. Let's break this down in the simplest way possible. If an investment drops 10%, you need about 11% to recover. That feels manageable, right? But if it drops 50%, you don't need 50% to recover. You need 100%. That's not opinion. That's math. According to data from Vanguard and Morningstar, portfolios that experience drawdowns greater than 40% statistically take multiple years longer to recover, if they recover at all. Many investors exit before that happens. Why? Because pain changes behavior. Now here's the uncomfortable question. If the market drops 50% tomorrow, would you really hold? Most people say yes, until it actually happens. This is why drawdowns matter more than returns. A portfolio earning 15% annually with massive swings often underperforms a portfolio earning 8–10% with controlled risk, simply because the investor stays invested longer. JP Morgan's long-term investor behavior studies show that the average investor underperforms the market by 3–4% annually, not because of bad assets, but because of bad timing driven by fear. So where does fear come from? Oversized risk. This is where the 1% rule enters the conversation, not as a strategy to get rich, but as a strategy to not get wiped out. The 1% rule is simple in concept. On any single trade or investment idea, you never risk more than 1% of your total capital. Not 10%, not 20%, not this one feels special. Why does this matter so much? Let's compare two investors with $10. Investor A risks 20% per trade. Investor B risks 1% per trade. If Investor A is wrong just 3 times in a row, a very normal event, the account can drop close to 50%. At that point, decision-making changes. Fear replaces logic. Investor B can be wrong 10 times in a row and still be standing. Ask yourself honestly, who survives long enough to benefit from compounding? Professional traders understand something most retail investors ignore. You don't control outcomes, you control exposure. According to a study published by the CFA Institute, institutional traders prioritize position sizing over entry accuracy. Why? Because even the best strategies lose 40–50% of the time. So if losing is guaranteed, why risk everything on one idea? This is where comparison becomes powerful. A gambler asks, how much can I make? A risk manager asks, how much can I lose and still play tomorrow? That single difference separates short-term excitement from long-term wealth. And here's another uncomfortable truth. Big wins don't build wealth if big losses erase them. A portfolio that gains 30% one year and loses 40% the next is not progressing, it's moving backward emotionally and mathematically. This is why the 1% rule is not about being conservative. It's about being unbreakable. Data from NASDAQ historical volatility reports shows that markets experience a 10% correction roughly once every year and a 20% drawdown every few years. These are not rare events. They are normal. So the real question becomes, are you structured for reality or for hope? Hope assumes markets will cooperate. Risk management assumes they won't. And once you accept that losses are part of the game, something powerful happens. Fear loses control. Because when no single loss can hurt you badly, emotions stop making decisions for you. And this is where most people finally realize the secret isn't avoiding losses, it's surviving them. Now think about this. If protecting 1% per trade can prevent a 50% drawdown, why would anyone ignore it? The answer lies in ego, impatience, and misunderstanding how wealth is actually built. And this takes us directly into the next layer of the problem. Why the human brain is wired to sabotage portfolios exactly when discipline matters most. The biggest threat to your portfolio is not volatility. It's how your brain reacts to volatility. Behavioral finance studies from Harvard and the University of Chicago consistently show that humans feel the pain of losses about twice as strongly as the pleasure of gains. This is called loss aversion, and it explains why rational plans collapse under pressure. Ask yourself this: if you lose 5%, do you feel annoyed? If you lose 30%, do you feel panic? That emotional difference is the line between discipline and destruction. To make a long story short, big losses don't just damage money, they damage decision-making. This is why investors who suffer deep drawdowns almost never recover optimally. They sell too early, they hesitate too long, they stop trusting their own system. According to Dalbar's annual quantitative analysis of investor behavior, the average equity investor earns far less than market returns, largely because emotions override logic during drawdowns. And here's the key insight: most people miss emotions scale with position size. The bigger the risk, the louder the fear. This is exactly why the 1% rule works, not because it predicts the market, but because it keeps emotions manageable. Let's put this into perspective. If your portfolio is $50,000, 1% risk means a maximum loss of $500 on a single idea. That's uncomfortable but survivable. You can think clearly. You can follow your rules, you can continue. Now imagine risking 10%, $5,000 on one trade. Suddenly every price movement feels personal. Every red candle feels like a mistake. And now you're no longer investing, you're reacting. Is it really surprising that most people fail? Professional money managers understand this deeply. Many hedge funds cap risk per position between 0, 5% and 2%, even when managing billions. Why would professionals limit upside if bigger risk means bigger profit? Because they understand a truth retail investors ignore. Capital preservation comes before capital growth. You can't compound what you don't protect. Now let's talk about recovery, because this is where math becomes brutal. A 10% loss requires and a 35% loss requires the 3% gain. A 50% loss requires a 100% gain. A 70% loss, you need over 230% just to break even. This isn't motivation. This is arithmetic. According to research from Fidelity, portfolios that experience drawdowns above 40% rarely achieve long-term outperformance, even if markets recover. Why? Because the investor often changes strategy mid-recovery. So here's the rhetorical question that matters most. Why accept a loss that mathematically handicaps your future? The 1% rule acts like a circuit breaker. It limits damage before damage compounds. Now compare two scenarios. Scenario 1, an investor ignores risk limits. One bad trade leads to another. Losses stack. Confidence erodes. Eventually, a 50% drawdown occurs. At that point, survival becomes the goal, not growth. Scenario 2, an investor follows the 1% rule. 10 losses happen in a row. The account is down roughly 10%. It's unpleasant but functional. The system remains intact. Opportunities still matter. Which investor still has options? This is why survival is not passive, it's strategic. Another critical misunderstanding is this belief: if I reduce risk, I reduce profits. That disagrees. A study by BlackRock comparing high volatility portfolios to risk-controlled portfolios over multiple decades found that lower volatility strategies often produced equal or better long-term returns, primarily due to reduced drawdowns and steadier compounding. Why does this happen? Because compounding works best when volatility is controlled. Imagine two portfolios. Portfolio A gains is 25%. Portfolio B gains 10% consistently. Over time, Portfolio B often wins not because it's exciting, but because it stays intact. This leads to a powerful realization: big wins don't matter if you can't keep them. And this is where the 1% rule becomes more than a tactic, it becomes a mindset. Instead of asking, how much can this trade make? You ask, how much damage can this trade do if I'm wrong? That single shift changes everything. It turns investing from prediction into probability, from emotion into process, and probability always favors those who stay alive long enough. Now let's address a common objection. What if I miss the big move? Here's the reality. Missing a big move is far less damaging than being forced out of the game. Markets offer infinite opportunities over time. Capital does not. According to data from the NYSE, the market's biggest gains often occur near its worst declines. Investors who suffer massive drawdowns are usually too scared or too depleted to participate when recovery begins. So the real risk is not missing upside. The real risk is not being there. This brings us to an uncomfortable but necessary comparison. Speculators chase excitement. Investors design systems. Speculators focus on being right. Investors focus on being resilient. And resilience starts with how much you allow yourself to lose. The 1% rule doesn't make you cautious, it makes you consistent. And consistency is what quietly separates long-term winners from everyone else. Now that you understand why psychology, math, and survival all point to the same rule, the next question becomes unavoidable. Now let's make this practical, because understanding risk in theory is easy. Applying it in real markets is where most people fail. Different markets have different personalities, but risk behaves the same everywhere. Stocks, crypto, forex, volatility doesn't care about your confidence. To make a long story short, the 1% rule is universal, but its application changes. Let's start with stocks. In the stock market, many investors believe diversification alone protects them. They buy 10, 20, even 50 stocks and assume they're safe. But here's the problem. Diversification without position sizing is an illusion. If one stock makes up 20% of your portfolio and drops 40%, your entire portfolio feels it. According to data from S&P Dow Jones indices, over 40% of individual stocks suffer permanent capital loss over their lifetime. That means holding alone is not protection. This is where the 1% rule quietly steps in. Instead of asking, how many shares should I buy? You ask, how much am I willing to lose if this stock collapses? If your portfolio is a 100 or 1,001% means 400,000 maximum loss. If your stop loss is 10% away, your position size adjusts automatically. This removes guesswork. It replaces emotion with structure. Now ask yourself, why do most investors skip this step? Because it feels slow. But slow is stable, and stable compounds. Now let's talk about crypto, where ignoring the 1% rule becomes dangerous fast. Crypto markets can drop 20-30% in a single day. According to CoinMarketCap historical data, Bitcoin has experienced multiple drawdowns exceeding 70%. Most altcoins never recover from those levels. So here's the rhetorical question. If a 50% drawdown in stocks is painful, what happens in an asset that can drop 80%? This is why position sizing matters more in crypto than in traditional markets. Risking 1% per trade in crypto doesn't mean small positions, it means controlled exposure. You accept volatility without letting it control you. Professional crypto funds often cap exposure per position precisely because of this. They understand that survival through volatility is the edge. Now consider Forex, a market where leverage magnifies mistakes. Forex brokers often offer leverage of 50-1, 100-1, even 500-1. That sounds like opportunity, but it's actually a test of discipline. According to data from the European Securities and Markets Authority, over 70% of retail Forex traders lose money, primarily due to excessive leverage. Leverage is not the enemy. Uncontrolled leverage is. The 1% rule transforms leverage from a weapon into a tool. You use leverage to optimize capital efficiency, not to amplify risk. So instead of thinking, how much leverage can I use? You ask, how little risk can I take and still participate? That's professional thinking. Now let's compare two traders. Trader A uses leverage aggressively, risks 10% per trade, and aims for fast growth. Trader B risks 1%, focuses on consistency, and accepts slower progress. After a losing streak, something statistically inevitable, Trader A is damaged. Trader B is annoyed but operational. Which trader survives long enough to improve? This is where compounding quietly enters the conversation. Compounding only works when losses are controlled. Albert Einstein reportedly called compounding the eighth wonder of the world, but compounding requires time. Drawdowns steal time. A portfolio down 50% doesn't just lose money. It loses momentum, confidence, and opportunity. Data from Morningstar shows that portfolios with smaller drawdowns recover faster and benefit disproportionately from market rebounds. So when people ask, why focus so much on risk? The answer is simple, because risk determines whether compounding ever gets a chance. Now here's another powerful comparison. Two investors both average 10% annual returns. Investor 1 experiences wild swings up 30%, down 25%. Investor 2 experiences smoother growth up 8% consistently. Over 20 years, the second investor often ends up with more wealth, not because of higher returns, but because of lower volatility drag. Volatility drag is the hidden tax on aggressive strategies, and the 1% rule minimizes it. Now let's address another misconception. Many believe the 1% rule limits upside during once-in-a-lifetime opportunities. But here's the truth. Markets create opportunities continuously. What feels rare emotionally is often statistically normal. Missing one move does not end your journey. Blowing up your account does. So here's the real strategic question. Would you rather be right once or solvent forever? This mindset shift changes how you approach every decision. Instead of chasing certainty, you manage uncertainty. Instead of predicting outcomes, you prepare for them. And preparation always beats prediction. Now that we've seen how the 1% rule applies across different markets, the next layer becomes even more critical. How exactly does this rule protect you during market crashes, and why investors who ignore it are usually forced to exit at the worst possible time? Market crashes are the ultimate test of any strategy. They don't care about experience, credentials, or optimism. Crashes expose weaknesses in capital, discipline, and preparation. To make a long story short, a 50% drawdown doesn't just hurt your account. It destroys confidence, forcing emotional mistakes that multiply losses. Let's analyze why. Imagine an investor who risks 10% per position. The market suddenly drops 20% in a week. Suddenly, positions that seemed safe are bleeding, and the investor faces a 40-50% drawdown in total. Panic sets in, calls are made. Positions are sold at a loss. Opportunities evaporate. Now compare an investor applying the 1% rule. Same market drop. Individual positions lose 1%, 2%, or 3% at most. The portfolio is affected but not catastrophic. The investor can stay in the market, follow their system, and buy opportunities at discounted prices. Historical data confirms this. During the 2008 financial crisis, mutual funds that used strict risk limits and position sizing lost far less than the average market and recovered faster, often outperforming over the next decade. The takeaway is clear: controlling risk doesn't just prevent loss, it ensures you survive to capitalize on rebounds. Now, let's talk about probability. Many investors ignore risk because they overestimate their skill. They believe, I'll just pick winners, I'll be right more often than wrong. Reality check. Even professional traders are wrong nearly half the time. According to a report by the CME Group, the average successful day trader wins only about 45-55% of trades, yet remains profitable because losses are strictly limited. This is the power of the 1% rule. It turns losing into a manageable, predictable part of your strategy. Rhetorical question. If losing is inevitable, why risk amounts that could destroy you? Another overlooked truth: compounding is your best ally, but only if your capital survives. Let's do the math. A portfolio loses 50%. To recover, it needs 100% gain. Lose 70%, you need 233% just to break even. These aren't theoretical examples, they happen in real markets. S&P 500 data from 1929 to 22 shows multiple drawdowns exceeding 50%. Investors without strict risk management never fully recovered, while those who protected capital not only survived, they thrived. Here's a critical comparison. Investor A chases returns aggressively without risk control. Big wins are followed by catastrophic losses. The account is volatile, stress is high, decisions are emotional, recovery is slow. Investor B controls losses via the 1-cent rule. Returns might feel smaller short term, but capital survives drawdowns, emotions remain stable, and opportunities compound steadily. Which path do you think leads to long-term wealth? Another key point is leverage. Leverage magnifies gains, yes, but it also magnifies risk. Over-leveraged investors during crashes face margin calls, forced liquidation, and permanent capital loss. The 1% rule limits per trade exposure, ensuring that leverage doesn't turn into self-destruction. Ask yourself, when the next crisis hits, will your portfolio withstand it or collapse under pressure? Let's take a real-world perspective. During the March 2020 COVID crash, the S&P 500 lost 34% in just 33 days. Many retail investors panicked and sold. Meanwhile, funds employing strict risk management saw losses limited to 8-20%, allowing them to reinvest at market lows. Months later, those investors had fully recovered and exceeded prior highs, while panicked sellers were left behind. This demonstrates another principle: survival creates opportunity. If you understand this, the 1% rule becomes less about avoiding loss and more about positioning for the next big move. You're not trying to predict the market, you're preparing for its natural behavior: volatility, uncertainty, and cycles. Another factor to consider is psychology during drawdowns. Behavioral finance research shows that losses trigger stress hormones like cortisol, which reduces rational thinking and increases impulsive decisions. Large drawdowns not only hit your wallet, they hijack your mind. Limiting risk through the 1% rule keeps stress manageable, ensuring that decisions are based on logic rather than panic. Now, a common objection: but what if I miss the moonshots? Here's the truth: markets present opportunities daily. Missing one trade does not destroy your future wealth, but a blown account does. The 1% rule ensures that even when you miss trades, you remain in the game to capitalize on the next opportunity. Think of it as a shield rather than a restriction. A shield doesn't make you faster, but it ensures you can keep moving. Without it, the first hit could end your journey. Let's also discuss portfolio diversification in this context. The 1% rule works best combined with careful allocation across uncorrelated assets. This doesn't just reduce losses, it stabilizes returns, making compounding more effective. According to research from Morningstar, diversified portfolios with strict per-trade risk limits historically outperform concentrated portfolios when adjusted for risk over decades. And here's the subtle but powerful point: risk management compounds confidence as much as capital. When every trade or investment has a capped downside, you trade without fear. You make decisions strategically rather than emotionally. And that psychological edge often matters more than any technical indicator or market forecast. Finally, let's make it relatable in numbers. If your account is 50,000 and you risk 1% per trade, a single loss costs 500. 10 consecutive losses, 5,000, 10% of your portfolio manageable. Keep following your plan and recovery is straightforward. Now increase that to 10% per trade, 3 consecutive losses, 15,000 gone, 30% of your portfolio. Suddenly recovery requires aggressive trades, stress spikes, and mistakes multiply. The difference is survival versus destruction, and the 1% rule is the line between them. Now that we understand how crashes, psychology, leverage, and compounding interact, the next question becomes: how do you implement the 1% rule effectively across all markets, without sacrificing opportunity, but still surviving every potential drawdown? Now we're entering the part that separates theory from practical application. The 1% rule sounds simple, but execution is where most investors fail. Many know it intellectually, but their positions tell a different story. Let's break down exactly how to implement it in a way that works across stocks, crypto, forex, and commodities. Step 1: calculate your total capital. Your total capital isn't just the money in your brokerage account, it's all investable funds, including cash reserves, retirement accounts, and short-term savings. You need a clear picture of what you can afford to risk. Step 2: determine your per-trade risk. 1% is the maximum you allow yourself to lose per position. If your account is 50,000, that's 500. This number is sacred. It's not negotiable. If a trade could potentially lose more than this, reduce your position size. Step 3: set stop losses or exit points. A stop loss isn't just a technical tool, it's a psychological insurance policy. It ensures that if the market moves against you, losses are limited automatically. For example, if a stock is trading at 100 and you're willing to lose 500, your stop loss might be at 95. Step 4. Adjust for volatility. Not all markets behave the same. Cryptocurrencies are far more volatile than large-cap stocks. Forex can swing wildly in minutes. Commodities can gap overnight. The 1% risk must always be calculated based on actual volatility, not arbitrary numbers. You may need fewer units in volatile markets to maintain the same 1% risk. Step 5. Leverage responsibly. Leverage magnifies risk. If you're using margin or futures, ensure your actual loss in dollars never exceeds 1% of total capital, regardless of leverage. Many traders fail here because they focus on position size without considering leverage. Step 6. Track your risk-adjusted performance. It's not enough to see profits or losses. You must analyze performance based on risk taken per trade. Over time, you'll see which strategies generate the best returns relative to the risk you assume. This is how professional traders measure success, not by raw gains, but by gains per unit of risk. Now let's look at how this protects you during real crashes. Imagine the market drops 30% in a week. Without a risk cap, panic sets in, losses compound, and portfolios can collapse. With 1% risk, your largest positions may only lose 1–2% individually. Your portfolio may be down 5–7% overall, not catastrophic. You maintain liquidity, confidence, and the ability to buy assets at discounted prices, turning market panic into opportunity. Ask yourself if survival gives you the chance to buy at lows. Isn't limiting losses the ultimate form of opportunity creation? Next, we consider position sizing across multiple trades. Many investors risk 1% per trade, but if they hold 50 positions simultaneously, they effectively risk 50% of their capital at once. This is called portfolio risk aggregation, and ignoring it is a common mistake. The solution: calculate total potential loss across all positions. Keep it within a maximum threshold, e.g. 5–10% of your portfolio. This ensures even multiple losing trades don't create catastrophic drawdowns. Now let's talk about mental discipline. Even with perfect numbers and formulas, humans often violate rules. FOMO, greed, or overconfidence can lead to oversizing positions. This is where automation or pre-set stop losses help. The 1% rule only works if it's non-negotiable. Think of it like a seatbelt. You don't remove it when the ride gets bumpy. Historical examples highlight this vividly. During the 1987 crash, portfolios with strict risk limits survived and capitalized on post-crash rebounds. Those without limits often suffered losses exceeding 50%, many of which were never fully recovered. Now, let's discuss scaling over time. The 1% rule doesn't limit growth. It preserves the ability to grow consistently. By risking a small, controlled percentage, your account can survive losing streaks, take advantage of winning streaks, and compound steadily. Over decades, this disciplined approach can produce wealth that reckless short-term trading never achieves. A simple numerical illustration: portfolio, the 50,000 risk per trade, 1% average winning trade, 3% losing trade, 1% even with a 50-50 win-loss ratio. Consistent application produces growth, while surviving drawdowns ensures you stay in the game long enough for compounding to work its magic. Now let's address psychological resilience. When your largest position can only hurt you 1%, your brain stops overreacting. You make decisions rationally. You follow your system. You avoid panic selling. Emotional stability often turns small edges into long-term dominance. Finally, let's connect this to the concept of drawdown protection. The 1% rule is essentially an insurance policy against large drawdowns. By controlling risk on every trade, you ensure no single mistake can erase years of progress. Data from multiple decades of market performance shows that portfolios with controlled risk outperform during turbulent periods, even if they underperform slightly in stable bull markets. The key takeaway: the 1% rule is not a limitation, it's freedom. Freedom from fear, from panic, from destruction. And freedom is the ultimate advantage in investing. Next, we'll break down specific examples of 1% rule implementation in stocks, crypto, and Forex, showing exact calculations, position sizing, and stop-loss strategies that allow you to survive drawdowns up to 50% and beyond. Now let's dive into real-world examples of how the 1% rule works across different markets. Seeing numbers in action makes the concept far more tangible. Example 1: stocks. Imagine a 100,000 portfolio. You identify a stock trading at 50 with a technical setup suggesting potential upside, but also volatility. You're willing to risk 1% of your portfolio on this trade. That's 1,000. You calculate the stop loss at 45 per share. That's a 5-hour loss per share. To risk 1,000, you buy 200 shares. If the stock hits the stop loss, your maximum loss is 1,000. Even if the market collapses tomorrow, your portfolio is down just 1%, manageable, survivable, and psychologically intact. Now, let's contrast this with ignoring the rule. Risking 10% of your account on the same trade with identical stop-loss placement means 2,000 shares. The same price movement triggers a 10,000 loss, 10% of your capital, creating stress, panic, and possibly forcing emotional mistakes in other positions. Key takeaway: risk per trade dictates survival, not just strategy accuracy. Example 2. Cryptocurrency. Crypto is far more volatile than stocks. Let's say you have a 50,000 crypto portfolio. Bitcoin is trading at 30,000 but can swing 30,000 intraday. You apply the 1% rule, maximum loss per trade 500. With 3,000 potential drop per unit, you buy only 0.66 BTC. If Bitcoin drops 3,000, your loss is 500. Without this rule, buying 1 BTC at 30,000 exposes you to a 3,000 loss, 6% of your total portfolio, instantly putting you under psychological and financial pressure. Even during extreme drawdowns, like March 2020 or late 2017, this small exposure ensures survival. You can withstand multiple losing trades in a row without forcing liquidation or panic exits. Key insight: volatility magnifies the need for strict position sizing. Example 34x allows massive leverage, sometimes 51 or more. Suppose you have a 20,000 account and trade EUR/USD with 50v1 leverage. A standard pip movement can create gains or losses far exceeding your unleveraged capital. By applying the 1% rule, your maximum risk per trade is 200. You calculate the lot size to ensure that even with leverage, the most you can lose is 200 if your stop-loss triggers. Without this discipline, just a single adverse movement could wipe out 10–20% of your account. With repeated trades, a margin call or account blow-up is almost guaranteed. Key insight: leverage doesn't replace risk management. It magnifies mistakes if the 1% rule isn't applied. Now let's discuss portfolio aggregation, because many investors apply the 1% rule per trade but ignore total exposure. Suppose you hold 10 positions in different assets, each risking 1% individually. Total potential loss is not automatically 10%. Correlation between positions can amplify losses. Stocks in the same sector, altcoins tied to Bitcoin, or currency pairs moving in tandem can create hidden portfolio-level risk. Professional traders calculate total potential loss across correlated positions. They may adjust individual risks to 0.508% to keep total potential drawdown within a safe 5% threshold. This prevents cascading losses even during systemic market crashes. Now, let's look at psychological resilience in action. Imagine a trader applying the 1% rule during a sudden market crash, a 20% drop in a day. Positions hit stop, losses one by one. Each loss is small, predictable, and manageable. The trader remains calm, evaluates opportunities, and can even buy assets at temporary discounts, turning volatility into advantage. Compare this to a trader ignoring the rule. The same crash wipes out 20–30% of their portfolio. Panic ensues. Emotional decisions follow. They may exit all positions, missing the recovery that occurs within days or weeks. Losses compound, not just financially, but psychologically. This is why survival is more valuable than prediction. Next, let's consider compounding over time with the 1% rule. Even with modest returns, protecting capital allows exponential growth. Portfolio to 50,000 average winning trade, 2% maximum risk per trade, 1% even if only 50% of trades are winners. The portfolio steadily grows while remaining protected from catastrophic drawdowns. Now consider a high-risk approach, 10% per trade, same win rate. One losing streak triggers a 30–50% drawdown. Recovery is slow, compounding is interrupted, and psychology is shattered. Mathematically, the 1% rule turns volatility from an enemy into an ally. You take small losses, let winners run, and survive to compound over years. Finally, let's address a common misconception. Many investors fear the 1% rule limits returns. They believe big profits come only from big risks. Reality check: long-term wealth comes from surviving market cycles. Limiting per trade losses ensures you stay in the game long enough for small, consistent gains to compound into significant wealth. Rhetorical question: would you rather risk it all for a single moonshot, or preserve your portfolio to profit from every opportunity that comes over decades? This mindset separates gamblers from true investors. Next, we will explore how the 1% rule protects against multi-asset crashes, including correlated markets, black swan events, and systemic risks, ensuring you can survive a 50% drawdown without ever panicking.